Hi, this is Bill Bronchick, and in this video I'm going to share with you 4 secrets for buying properties with little or no money down, with no partners, with no credit, and without begging a bank for a loan. Yes, I'm just like you. I don't want to go begging a bank for a loan, and I don't want to put 25-30% down and sign personally on that loan either. I want to acquire properties with little or no money down, with little or no risk, and no personal liability. If you're like me, listen carefully. So, strategy number 1, the master lease with option. In this strategy, what you're going to do is lease a property from an owner with an option to purchase for the balance of his mortgage. So let's say the property's worth $1.50 and he owes $1.30. Well, by the time he sells it and pays closing costs and realtor costs and pays off his mortgage, there's really not a lot in there for him. So it wouldn't be that hard to say to a seller, listen, I'll lease it from you for your monthly mortgage payment, and I'll give an option to buy that property for the next 3 years for the balance of your mortgage. Now, if that monthly payment, principal, interest, taxes, insurance, is $200 to $300 less than market rent, that'll work for you because you could sublet it for market rent, make cash flow, and then give an option to your tenant to buy it from you at a price of at least $150, if not $155, $160, tomorrow's price. Because remember, you're giving your tenant buyer an option for 2 years to buy from you. Why 2 years and not 3? Well, you just want to leave a year cushion in there between the option with the owner and then the option you give the tenant, just in case your tenant does not exercise and buy the property. Gives you a chance to do it again. So you lease it from the owner for his mortgage payment monthly, you lease it for the balance of his mortgage as an option price, and then you sublet to a tenant for monthly cash flow. When your tenant is ready to buy from you, he exercises his option, and then you go to the owner and exercise your option. And then in a double escrow or double closing, you buy and flip it to your subtenant. As you probably figured out by now, there are 3 profit centers in this deal. Number 1, the monthly spread between the market rent and the mortgage payment. That should be at least $200 to $300 a month. Number 2, you're going to ask your tenant buyer for non-refundable earnest money up front, usually about $3,000. And of course, you're not going to pay anything to the owner, very little, if anything, at most, first and security. Then you're going to get the back end spread on the deal, which is the difference between the balance of the owner's mortgage, about $130, or maybe a little less by the time you've paid it down a little bit for a year or two, and the $155, $160 you sell it to the tenant buyer for. So there are 3 distinct profit centers and very little risk in a deal like this if you follow my strategies. Number 2, buying a property on a contract for deed or land contract. By the way, those are the same thing. A contract for deed or land contract is similar to a lease option, but it's not a lease with an option, it's a sale. So the seller sells you the property for basically same scenario for the balance of his mortgage, which is $130,000. And what we do is we sign a contract with the owner that we're going to make him payments that mirror his balance, the balance of his payments on his mortgage and the monthly payments for principal, interest, taxes, and insurance. And in that scenario, basically, you're mirroring the balance of his mortgage, so every time you make a payment, the payoff to the seller goes down with his underlying loan. So at any time, the balance of the contract is the balance of his mortgage. Now, in doing that, you get the equitable ownership of the property, which means you have the right to resell it the same way. So you can turn around and resell it on a contract, and then your buyer, let's say, pays $160, you get 5 or 10 down, and then you carry the balance of that contract at a higher interest rate, about 2 to 3 points higher than the interest rate on the underlying loan. And again, there are 3 profit centers here. Number 1, you're going to get a down payment from your buyer of $5,000 to $10,000. Number 2, you're going to get a spread between the payments you're collecting on the contract from your buyer and the contract you're paying to the owner. And number 3, the difference in the balances when the buyer pays you off and refinances or sells, and then you pay off the underlying, there's a chunk there waiting at the back end. Very similar in practice to a lease option in terms of the structure of the payments, but it is a purchase and sale, whereas a lease option is still a lease and a sublease. That is until everybody exercises their options. So that's called a contract for deed or installment land contract. The third type of transaction is what's known as a wraparound mortgage or all-inclusive trust deed. This is almost identical to the land contract or contract for deed, except title passes to the buyer at closing instead of when it's paid off. Now, with a contract for deed or installment land contract, the deed remains in the seller's name until the balance of the contract is paid off. In the case of a wraparound mortgage or all-inclusive trust deed, the the deed goes into the buyer's name and the seller takes back an all-inclusive note and all-inclusive mortgage or trust deed. I know that one's a little confusing, but just understand the basic concept. It's almost identical to the situation of number 2, except the way the collateralization works. In the case of a wraparound mortgage or all-inclusive trust deed, the buyer has title and the seller must foreclose to get the property back if the buyer defaults. And then the fourth way is what we call a straight out subject to. That is, the seller just deeds the property straight out to the buyer, subject to the existing mortgage. The buyer makes the payments directly on the seller's mortgage, directly to the seller's lender, and the seller has no more interest in the property, no ownership, no right to get it back, no right to foreclose if the buyer defaults, but he's still stuck on that mortgage. Now, that might be a difficult negotiation if the seller understands that risk, which is why you're only going to probably be able to do a subject to on a seller who's pretty darn motivated and all ready to pretty much walk away from the property. If you'd like more information about these 4 financing type strategies, drop me an email, bill@bronchick.com.